What's up, everyone? This is Tyler from Foundation Investing, and today we're going to talk about why Apple is a sell. Alright, so let's get into it. So our 2016 outlook for Apple. Can it revive the legendary growth story we've known to come and love over the years? So here we'll start with the price chart. You can see price action wise, Apple hasn't been doing too well. It's about 20% off the highs. And right on that support line, which looks like it could make it sell off. FANGs are just leaving Apple in the dust. So you can see here, I put up the hot stocks of 2015, Amazon, Google, Facebook, Netflix. All these have been ripping, but Apple has been going sideways, okay? And when Apple's going sideways, that tells us that investors just aren't believing in their growth narrative right now. So let's kind of check out why. So when you look at a growth narrative, you need to search for the key drivers. And in Apple's case, they're not repatriation and tax implications. The key drivers in Apple are iPhones and China sales. And it's pretty easy to determine why these are the key drivers that Wall Street cares about. I pulled up Q4 2015 unaudited summary data, and you can see here for the iPhone, 32 billion of the 51 billion in revenue in Q4 2015 makes up iPhone sales, and that's enormous. So over 2/3, or roughly around 2/3 of Apple's revenue comes from the iPhone. So Apple is pretty much a one-product company. That's why Wall Street cares so much about iPhone sales. And now when it comes to China, if you look at the top area and we compare Q4 2015 to Q4 2014, you can see revenue is drastically growing in China, but it's sort of stagnant everywhere else. In Japan, America, Europe, it's pretty much stagnant. But in China, we had an increase from 6 billion to 12.5 billion. And so that's why Wall Street is so focused on the key drivers of iPhones and China, and that's why those numbers are what's moving the stock up and down. Here's another graph just describing why China is so important. The yellow there is the year-on-year revenue growth by region, and you can see how much more influential it is compared to other regional growth. But the problem that we have with this thesis of the China growth thesis is that the macro in China looks pretty ugly. And you can see here on the chart that the percent of debt to GDP has skyrocketed over the last 6 years, and we now stand to above 200% in debt to GDP. So the Chinese yuan is also weakening very, very quickly, and we think there's just much more weakening due as well. So why does all this matter for iPhone? China debt, a weakening currency. Well, high debt loads are deflationary and they precede economic slowdowns. So when countries have high debt, they're more prone to non-performing loans and credit crunches, just slowing down business in general. And then a weakening yuan makes it more expensive for the Chinese to buy American goods. So typically when governments get out of control debt, they print money to monetize the debt. When they print money, this weakens the currency and makes it more expensive for people at home to buy imported goods. And the Apple iPhone is an imported good for the Chinese. So we've already seen this dynamic in India, foreshadowing what we think is going to happen in China. Now here's the graph of the rupee, USD rupee, and it's going up, which means the rupee is weakening compared to the USD. And now iPhones are selling for much more than they did last year because of the currency exchange rate. So whenever a country's currency weakens, imports cost more and demand's just not as high because it's more expensive. And retailers in India have been confirming this year that sales and demand has been lower because of this reason. So we feel like the China narrative is just weak, and Wall Street agrees. Analysts have been continually downgrading expectations for the next earnings report. And a large part of their downgrades is due to Apple suppliers guiding down for the next quarters. Now, a lot of critics will come back and say, well, Apple has all this cash, they have billions in the bank, they can do something cool. The thing is they haven't. They're just buying back stock and pulling another IBM. Their market cap is enormous, $606 billion market cap. That's huge. And compared to the rest of the FANGs that I've listed here, it just doesn't look like there's that much upside left in the company. Now, they say that China's going to do it, but given the headwinds that we're seeing out of there, we don't think that China alone can propel this company up to $1 trillion market cap and make it worth sticking into the trade of the long side. And additionally, another risk to Apple right now is it's a hedge fund hotel. It's widely owned amongst hedge fund professionals. And when the growth narrative doesn't give the investors what they want, they all come out really quickly and pile out and try to cut their losses. So a good example of this is Valeant. So Valeant Pharmaceutical, it was a hedge fund hotel. There's some bad research that came out, ruined the growth narrative, and the thing cratered. So our conclusion is just the risk reward is not to the long side. It's not worth it anymore. There's better growth opportunities elsewhere. And it's possibly even a trade to the short side, but limited downside because the company is still highly profitable, so it's not like this thing's going to zero. We think the most probable outcome is a sideways range-bound trade like Microsoft from 2000 to 2015. And unless Cook and the gang decide to make a bold move, we're just not that interested in the stock. There's more compelling things out there in the market. So that's it, guys, for the presentation. Thanks for watching. If you liked it, please subscribe to the channel, leave a comment, and check out our articles on China and Apple. See you in 2016.